Hello and welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. If you have a question about shares, our phone lines are open, so please give us a call on 1300 30 34 35, and you can always email us on yourmoney@skynews.com.au. Joining me on the panel tonight, we have Michael Kodari from Kodari Securities, KOSEC, and Richard Hemming from Under the Radar. Well, Melbourne Cup Day, a lot of people would have been betting on the horses, but if we watch the market, we're in the first week of November, and November's quite an interesting one for the Australian share market. In fact, if we go back and look at the last 7 years, 3 out of the big 4 banks have actually managed declines every single one of the last 7 years. So is this year going to be the same? Let's get our panellists' view on the banks while we wait for your calls. I mean, Michael, we've started to see reporting out of the banks, and we'll get another update from CBA, a quarterly update later on in the week. What's your view on how the banks are travelling, and do you think they are a buy, a hold or a sell at the moment?
Well, Julie, interestingly, we've got 4 of the best banks in the world. So, there's 20 with AAA ratings and we've got 4 of them, considering that we have a population of about 23 million. Look, the banks have done very well. Financials, in general have outperformed. But going forward, that's the question. Can they keep up? They do give you a very high yield. If you were to put your money in the bank, you'd be looking at getting 3.5%, 4%. So, why not buy shares in the bank and get a higher return in terms of dividend yield? Look, we like the banks still, and we think with interest rates being so low, more businesses, more people will borrow more money, and they'll invest in property or the stock market. So, our top picks are your ANZ, your CBA.
Okay, so the big end of the market. Now, Richard, I know you like to focus on the small end of the market, but looking at the financial space, are there any smaller financial companies that have your interest at the moment? What do you think of the big 4 banks?
Well, I think in relation to the financial services market, there's been so much consolidation, and that's certainly been, the ones that we have liked have been snapped up, like SFG. But I think on the banks, I just think, like we saw this week, Westpac report a very good result, but we know that, capital intensity is the problem, and there's going to be pushback into the banks are world-class whingers, we know that, but there is certainly a lot of pushback from them in relation to some of the reforms that have been proposed by, flag wavers like David Murray. And, so there's some big issues coming up that I think, there's going to be some constraints on their capital that haven't been there before. They'll whinge about it a lot because they're the best in the world at that. But I think that, when you look at the dividend yields, as Gail Kelly said, there's question marks over whether it can be maintained and to keep within the higher capital adequacy ratios.
I mean, this is an interesting subject. So the Murray inquiry, it's due in November, and the view is that we are going to see capital needs being increased. So that's a cost for the banks, and usually that leads to, lower return on equity, lower returns, lower dividend growth. Is that what you're seeing for the big 4 banks, or do you think that it's just business as usual?
Long term, Julie, I mean, every portfolio's got a bank in it. In the past 4 weeks when the market had a hit, we started buying the banks. We made a good 7% return from them. But we did trade out, and there's more opportunities that I think that are out there that you can invest with. So, if the banks do get regulated and, they can't lend out as much as they can now in terms of the housing, you will see a hit. But, it's all about finding that right opportunity in the stock market. So, the banks have had a very good run. If you want to look elsewhere, maybe, you can look into healthcare or, telecoms or online retail. So, unfortunately, there's not much sectors to choose from. But if you're in the right ones, you can, get a healthy return.
And I guess that's one of the points. What's really been driving the performance of the banks, as well as the telecom space, is the fact that we are seeing such low interest rates here in Australia and the rest of the world as well. And it's been, helping these high-yielding investments. So having a look at, the high yield, the low interest rate environment versus needing more capital, where else do you put your money?
Well, I think that's a good point, but we are among the most concentrated markets in the world, which opens up to opportunities for private client investors because there's a big tail in the Australian market. But I would say that, right now I think, Julia, lots of companies are trading really well, but they're trading as part of a pack. as soon as you show weakness in that pack, you get trampled on, like we saw with Woolworths this week. So I think the danger of not meeting market expectations in a quite an expensive market has never been higher, and we've seen we're seeing a lot more volatility in the markets than we've seen for a long time, and we're going to see the market fall out of bed now and then because of that debt-related volatility. So I think there is a lot more danger in places like the banks than I think people realise. I mean, you have to realise that for every dollar that the bank owns, they've lent 10 out. So there is so much economic risk in relation to housing, in relation to the general economy, that I think people just have to, just look at their portfolios, because diversification, I think, has never been more important.
Okay, so that's the banks. It's a really big topic, and I'm sure we'll come back to the banks, especially given the impact of overseas investors on the banks as well, the Murray inquiry, and of course that very attractive yield for the time being. It is time for a viewer email. We've got one here from Matt, and Matt writes, what do you think of Empire? The share price held up well during recent volatility. The fundamentals also look good, and they seem to have good growth potential. So looking at Empire, this is in the IT area. It's an IT services company. They look at consulting, applications and infrastructure services as well. I mean, the focus of Empire is multi-year managed services contracts and higher margin project services as well. So an attractive area to be. They have been on the acquisition trail. So the last announcement that they made was that they had made an acquisition. It is a smaller company. Richard, what do you make of this one?
Oh, I think they're in a pretty good space, but it just depends how they're attacking the space, because I think like what happened with a lot of these management IT consulting type companies, they were state-based and then they achieved a lot of growth by expanding, nationally. Right now, the sort of companies that we look at in the sector are like ASG, are ones that are sort of embracing the cloud. Now, you can get whacked by this kind of this hug of new technology like Macquarie Telecom did, because sometimes it means lower margin, even though those margins might be, even though the business might be more consistent, because it will be like what they call software as a service kind of revenue stream, which lasts longer rather than just project related, and that's really positive. But what gets hit is the margins that they get. So there is risk moving into this new business sort of area of the cloud. But I think it is the future, and I think companies that are all looking to, like the corporate world, which is all looking to lower costs. I think IT services and a user pays environment that the cloud embraces, I think that's a really good area. And I'd just like to know a bit more about Empire and how much they're embracing that sort of new technological innovation.
Okay, so having a look at new technology and the impact on this area, I guess looking at Empire, rather than being an IT services company which sends out consultants, it is a little bit more technical, so it tends to have engineers, so it's more on the technical side of things, so it doesn't tend to be as
they're still paid. They're still paid by the hour. They're still like, it's still a billable hour type company rather than a software as a service. So like an ASG is trying to say, and they're getting more successful at it. It's been a bumpy ride for them. They're trying to say, well, we'll take on, you just use the software as you need it, and we provide all the software for you. So they're providing stuff that would have been out of the realms of businesses like Oracle and SAS. They're providing that stuff that would have been out of the realms of kind of small to medium-sized businesses that are now, within their reach.
Absolutely. And I mean, looking at a company like Empire, is this one that you'd be buying into? Do you like it? What are the pros and cons here?
One of the key problems, Julia, I have with the company is it's giving a return on equity of 5%, almost half from the year before. So, I like a business that if I put $1 in, it gives you more than 5 cents. There's a company that I'm going to recommend tomorrow, which gives me a return on equity of about 30%. So, it's a business that every year you put $1 in and you get back 30 cents. That's the sort of company I like. It doesn't trade much. It's traded about $38,000 worth. So it's not a real investment-grade business for me to get into. But, you know, there's much more opportunities out there in the stock market than a stock like this.
Okay, so that was Empire. EPG is the stock code there. A very interesting company, a very small company as well, but it has been on the acquisition trail, and the share price has improved quite a bit over the last 6 months. Let's go to our first caller of the night. We have John on the call, on the line from Manduro. John, welcome to the show. What's your question tonight?
Hi, Julia. How are you?
Good. How are you doing?
Not too bad. Look, I just want to ask the panel there what they thought of Woolworths. They announced their profit, but their shares seem to be getting bolted a little bit, and but their sales were actually up. And you know, when you think of the growth that they can, every time a new suburb seems to pop up around Australia, there's always going to be a Woolworths and a Coles somewhere. And the Masters sales were actually better than probably everyone had thought. But are they good buying at this level at the moment?
Sure. So Woolworths has had quite a big pullback. It's actually under $34 at the moment, at $33.30 it traded today. We did see a big drop in terms of the share price due to the poor sales coming through. And I guess looking at a company like Woolworths, you know, there is Coles, which it competes again, but they're the two big players in the marketplace. They're pretty mature companies now. Growth is sort of levelling off. Are they just cannibalising their own sales at these type of levels? Do you still see Woolworths as a good buy at these levels, especially given the sharp pullback that we saw on the back of that sales number? Richard, what do you think?
Oh, well, I think like what I was saying before was like people were expecting Coles type, you know, level sales growth, and they got Woolworths level sales growth. You know, prices go down or something. No, that's Coles actually. But I think in terms of whether it's a buy or not, I mean, I think with a company like this, it's going to be very, very resilient, and you can never underestimate that for a long-term portfolio. But at the moment, the yield's just around sort of 4.5%, I think, the future dividend yield. I'd like to see it a bit cheaper than that to sort of justify kind of holding it for the long term, because I think what we've seen is that it's much harder to obtain kind of the kind of growth that Coles did, you know, with just the supermarket business that Woolworths has. So I think for me, I'd like to see it a bit cheaper. I'd like to see that reflected in the yield, because that's basically what you're buying that sort of stock for, is the income you're going to get.
Okay, so you want to see a greater yield on a stock like Woolworths, which is
like a stable participant in a very cosy sector that's not going anywhere, and you want to see a better pay.
There's only two ways for the yield to go up, and that's the share price to come down, or profit to go up, and the payout ratio to either go up as well. So looking at Woolworths, I mean, do you like the story of Woolworths? It was sold down heavily because Coles had a better sales growth rate, and Masters is just not doing what the market's expecting. So one of the, I guess, star areas of West Woolman's portfolio has been very much Bunnings and the hardware side of things, and Woolworths trying to cash in with the Masters brand, but it hasn't been doing so well, and sales, it looks like, not growing as strongly as Coles. So looking at the two, would you buy Woolworths because of the big sharp pullback that we've seen, or are you a Wesfarmers fan?
Look, Julie, I like the Woolworths concept, the way the layout of the stores are. It's very clean and fresh. In the past 3 years, though, you would have seen the return on equity drop from 33 to 26 to 24. I mean, these are businesses that are maturing, so they're large companies. There's so much expansion that they can do. Eventually, they're going to pull back and slow down, and that's one of the key problems. So if they do pull back and slow down, they're giving a dividend yield of 4.1%. They should be offering more for yields because these businesses are maturing. 4.1% is the average within Australia, so it's nothing to get excited about. But Woolworths long-term is a great business, but it depends if you want to hold it for the next 10 years and see a good return from, or if you want to get into other opportunities in the stock market. So, you know, a great business. Would I buy it? No.
Okay.
Yeah, I mean, like, you know, we're looking at some other retailers at the moment that are really in sort of more turnaround type situations, and I think sometimes if you're looking for an investment, like, you know, with the recent sell-off, with the recent weakness in the market, I think you've got value opportunities that much more enticing than Woolworths.
What type of retailers are you watching at the moment?
Oh well, I mean, specialty fashion is one that we've liked for a while, and I think that one they've kind of got a, they're growing their stores in Australia and Asia, but they've also got a good kind of internet strategy because they own their own product and they've disintermediated the designers. So basically they're kind of sourcing their product directly. So they're able to maintain a gross margin of 40 to 50%. So we think that's a good value stock at the moment.
Okay, lots to talk about, but we do have to take a short break. We will be back to answer more of your questions in just a moment, so stay with us. Welcome back to the Shares edition of Your Money, Your Call. We are still taking your calls on 1300 30 34 35, and you can email in on yourmoney@skynews.com.au. And we have Adonis on the line from Melbourne. Adonis, great to hear from you.
Hi, Julia. Welcome back. How are you?
Good. How are you doing?
Yeah, very well, thank you. My question is for Michael. I'm looking at adding Ardent Leisure and Oil Search to my portfolio. Ardent Leisure I really like. It's had a nice run of over the course of the year, up about 64%, pays an okay dividend of about 4.3, diversified income stream, footprint here and in the US and New Zealand. So I like the business as a whole,
sure.
And it's had a nice retracement back to that $3 support level, closed at 307 today. So just it looks like a reasonable buy to me at current levels. And as I said, I'm looking at adding an energy play and was interested in Oil Search again at current levels with what the production they've got planned for next year.
Sure. So having a look at Ardent Leisure first, AAD is the stock code. This is a company that looks at theme parks, it has fitness centres, there's family entertainment centres, which is called Main Event over in the US as well. And the share price has been doing fantastically well, as Adonis mentioned, up 56% over the last 52 weeks, pull back to that support line, just over $3, as long as we don't see a further fall, looking pretty good technically as well. Looking at Ardent Leisure, I mean, any reasons not to own a stock like this?
Yeah, look, Adonis has made these are interesting companies. Ardent Leisure's financially a very healthy stock. It's very steady. Return on equities, increasing at around 10% per year. Cash flows are increasing. So it's a good stock. If you're looking to invest in that sort of sector, I just find the sector very hard in terms of their costs are quite high. So 10% return on equity is just not enough for me. But it's a good business. It's very hard to operate in that sector. But for me, it's one you can have in your portfolio. But there are more stocks that I'm looking at with a much higher potential. I mean, if you watch me this year, I've brought you Ramsay Healthcare, TPG Telecom, Domino's Pizza, ResMed, Certex, all these companies that have done extremely well. But I like the company. I wouldn't invest into it at the moment. But Oil Search, it's very hard in the oil and gas sector to pick good stocks. And although this is quite an enticing one, it's not a sector that I'm investing in as of yet.
Okay, looking at Ardent Leisure, I mean, diversified portfolio there, is that one that would interest you?
We did well a long time ago out of Village, and there was some family issues there that got resolved. But I think with these sort of stocks, I think there's a price for everything, and this like Village back then was trading on 10, 11 times. This stock's very expensive, so it's sort of out of our universe. I just think trading on sort of 18, 19 times forecast earnings, I think there's a lot of, in a capital intensive business, I think there's potential to lose money.
Okay, so potential to lose money there, just cautious at these type of prices. What about Oil Search? I mean, we've seen a pretty big pullback now for Oil Search, and we've seen
I've seen a
energy
pullback for a lot of the oil companies. I mean, I think that's just how reflective of the oil price, and it's just going to be hard yards for companies, and I think more and more resource companies are going to embrace the Woodside kind of ethos of paying out more dividends, because that's really what investors want. And I think certainly we're seeing that from the BHPs and Rio Tintos of the world, but we've yet to see it from a kind of broader energy type companies. In that sector, we tend to sort of like the unconventional players, Sun Energy, SEA.
Okay.
So we tend to look at that kind of as a more potential, because there's not so much risk on the production side.
Okay, so looking at smaller players in that area, I mean, looking at Oil Search, it's been sold off with the rest of the energy companies, oil prices really falling on the back of concerns around global growth. So looking at the energy players, let's say the three big ones, Woodside, Santos and Oil Search, which one do you like?
Look, Woodside financially, fundamentally seems to be a much better company. But then again, these businesses where your prices are set, it's very hard. I mean, if oil is trading at 120, 140 or 80, you want to look at large companies that produce oil at a cheaper cost. But, it's very hard. You've got to identify where the oil is. You've got to dig it out. I mean, you need a lot of money to be in this business, and most of them fail. And, it's a sort of industry I don't want to be in. Mining is an industry that I don't want to be in. I mean, I was recommending mining stocks about 3 years ago. I've pulled back. I've completely changed sectors into healthcare, online retail and telecoms. But,
Okay.
You've got to be versatile. You can't stick somewhere. I mean, Warren Buffett says buy cheap stocks, but there's a lot that goes into it rather than just buying unwanted companies.
So you're staying away from growth, energy, materials, and you're looking at more defensive areas like healthcare. I guess retailing is more cyclical. But really not a fan of energy or the materials?
Not a fan of energy or mining at this stage. Look, I'm not conservative in the way we invest. I mean, for us, it's about finding those gems in sectors that are, booming. Healthcare, the aging population. You've got telcos. We've got some of the best telco companies. It's about picking the right ones, and you can get returns of 100%, 50% a year out of investing in these stocks.
I think that's fine, but I think, there aren't that many operators in some of these sort of growth sectors that you can pick and choose. Whereas in the energy sector, there are a lot to choose from. So I think on the same token, if you're willing to broaden your horizon, there are some good companies out there like Cooper Energy or Sundance Energy. It is a very specialised sector. That's the main point, I would say.
And there are a lot of smaller mining companies out there as well. It's quite interesting that you're avoiding miners as well as energy. What's your reason behind that?
Look, first of all, in terms of the demand globally, if China will slow down, it's slowing down. It's going to affect that sector. It's not very popular. There's not enough volumes being put through that sector. But I look at it like this: if I was to, invest $200-300 million in business, would I put my own money into a company that doesn't make any money? I wouldn't do that. So we wouldn't be putting our investors' funds into a business that's of high risk.
Okay, so concern about global growth prospects, especially
yes,
coming from China, so avoiding that mining space. Richard, more interested in some of the smaller end, and you mentioned Sundance Energy, SEA is the stock code. And on that note, we are out of time. I think we have to go to a break. But if you'd like to speak with our expert panel, please give us a call on 1300 30 34 35, or you can email us at yourmoney@skynews.com.au.